Did you know the IRS considers crypto property, not currency? That one mistake in how you think about your crypto could cost you thousands of dollars in penalties, back taxes, and interest you never saw coming. Most people buying, selling, and trading crypto have absolutely no idea they're creating a taxable event every single time they make a move. Not just when you cash out to dollars, not just when you sell at a profit. Every single move, and the IRS has been watching. In 2021, the IRS added a crypto question to the front page of every single American tax return, right at the top, before your income, before your deductions. They're not hiding it anymore. Today, we're going to break down exactly how crypto taxes work in the United States, in plain English, so you never get caught off guard by a bill you didn't see coming. Let's start with the foundation that changes everything. In 2014, the IRS issued guidance that classified cryptocurrency as property for federal tax purposes. Not currency, property. This is the distinction that trips up millions of Americans every single year. Here's why it matters. When you spend US dollars, there's no taxable event. You spend $50 on dinner, you owe no taxes on that transaction. But when you spend crypto, even to buy a cup of coffee, you have just completed a property sale. The IRS treats it exactly like selling a stock. You bought Bitcoin at $10,000, it's now worth $60,000. You use it to buy a car. Congratulations, you just realized a $50,000 capital gain, and you owe taxes on that gain whether you ever touched a dollar or not. That's the trap most people fall into. They think they're just spending crypto. The IRS sees a property disposition with a taxable gain, and it gets broader than most people realize. Taxable events in crypto include selling crypto for US dollars, trading one cryptocurrency for another. Yes, swapping Bitcoin for Ethereum is a taxable event. Using crypto to purchase goods or services, and receiving crypto as payment for work or services. Non-taxable events include buying crypto with dollars and holding it, transferring crypto between your own wallets, and in most cases, receiving crypto as a gift, though gifting crypto above certain thresholds has its own rules. The line between taxable and non-taxable is critical, and most people are on the wrong side of it without knowing it. Now let's talk about the two tax rates that determine how much you actually owe. When you sell or dispose of crypto at a profit, you owe capital gains tax, but the rate you pay depends entirely on one thing: how long you held it. Short-term capital gains apply to crypto held for 1 year or less. These gains are taxed as ordinary income at your regular federal income tax rate. Depending on your bracket, that could be anywhere from 10% all the way to 37%. Long-term capital gains apply to crypto held for more than 1 year. These gains are taxed at preferential rates, 0%, 15%, or 20%, depending on your income level. Let's put that in real numbers. You buy one Bitcoin at $30,000. 6 months later, it's worth $60,000. You sell. That's a $30,000 short-term gain. If you're in the 24% tax bracket, you owe $7,200. Now, same scenario, but you wait 13 months before selling. That same $30,000 gain is now long-term. At the 15% long-term rate, you owe $4,500. Same profit, same Bitcoin. $2,700 difference just because you waited 7 more months. That is the power of the 1-year holding threshold, and most active crypto traders completely ignore it, churning trades weekly and paying the highest possible tax rate on every single gain. The strategy is simple, but most people don't implement it. Before you sell, ask yourself, how long have I held this? If you're at 11 months, waiting 2 more months could save you thousands. Here's where it gets really dangerous. Most people know that selling crypto creates a tax bill. What they don't know is how many other events also trigger taxes, events they never even considered reporting. Crypto-to-crypto trades. This is the biggest hidden tax trap in the entire crypto ecosystem. When you swap Bitcoin for Ethereum, you have sold your Bitcoin. The IRS doesn't care that you never touched a dollar. You disposed of property at its current fair market value, and if that value is higher than what you paid, you have a taxable gain. Every DeFi swap, every token exchange, every rebalancing of your crypto portfolio, all taxable. NFT transactions. Buying an NFT with crypto is a taxable event. You just disposed of your crypto at market value. Selling an NFT for crypto is a taxable event. You just received property at market value. And if you created and sold an NFT, that income is likely taxable as ordinary income, not capital gains. Staking and mining rewards. The IRS has ruled that staking rewards are taxable as ordinary income at the fair market value when you receive them. So every time your staking rewards hit your wallet, that's income, even if you never sell them. And then when you eventually sell those staking rewards, any gain from the price at which you receive them is a separate capital gains event. Airdrops and hard forks. Receiving tokens through an airdrop is generally taxable as ordinary income at fair market value when received. Hard fork tokens, same treatment. The IRS wants their cut the moment those tokens land in your wallet. DeFi yield farming. Every yield payment, every liquidity reward, every interest payment from DeFi protocols, taxable as ordinary income when received. The complexity of DeFi has created an accounting nightmare for anyone who participated heavily in yield farming without tracking every single transaction. Now, let's talk about the part of crypto taxes that actually works in your favor: losses. If you sell crypto at a loss, that loss can be used to offset capital gains elsewhere in your portfolio. And if your losses exceed your gains, you can deduct up to $3,000 of net capital losses against your ordinary income per year. Additional losses can be carried forward to future tax years indefinitely. This is called tax loss harvesting, and in a volatile market like crypto, it's one of the most powerful tools available to reduce your tax bill legally. Here's how it works in practice. Say you have $20,000 in gains from Bitcoin, but you also have $15,000 in losses from a failed altcoin position. You can offset those gains, bringing your taxable gain down to just $5,000. And here's the critical difference between crypto and stocks: the wash sale rule. In traditional securities, if you sell a stock at a loss and buy it back within 30 days, the IRS disallows the loss. That's the wash sale rule. As of current IRS guidance, cryptocurrency is not subject to the wash sale rule, which means you can sell Bitcoin at a loss today, immediately buy it back, claim the loss on your taxes, and still maintain your position. This is a significant legal tax advantage that crypto holders have over stock investors, and it's one that Congress has been actively discussing eliminating. Use it while it exists. Here is the part that nobody wants to talk about, but absolutely determines whether you survive a crypto tax audit: record keeping. For every single crypto transaction, you need to know the date of acquisition, the cost basis, what you paid for it, including fees, the date of disposition, the fair market value at the time of disposition, and the resulting gain or loss. Across hundreds or thousands of transactions, across multiple exchanges and wallets, across multiple years, this becomes an enormous accounting challenge, and the IRS has made clear they expect you to have this documentation. There are several crypto tax software platforms, CoinTracker, Coinly, TaxBit, that can connect to your exchanges and wallets and automatically calculate your gains, losses, and taxable events. If you're actively trading crypto and you're not using one of these tools, you are creating a serious problem for yourself. One critical concept to understand is cost-basis accounting methods. The IRS allows you to choose how you calculate which coins you sold: FIFO, first in, first out; HIFO, highest in, first out; or specific identification. Choosing the right method can drastically reduce your tax bill. HIFO, selling your highest cost basis coins first, typically minimizes gains and is often the most tax-efficient method. Let's be direct about this. The IRS knows about your crypto. Major exchanges like Coinbase, Kraken, and Gemini are required to report user transactions to the IRS and issue 1099 forms. The IRS has used blockchain analytics firms to identify unreported crypto income, and the Infrastructure Investment and Jobs Act of 2021 expanded crypto reporting requirements significantly, including for brokers and DeFi platforms. The penalties for failing to report crypto income include back taxes on all unreported gains, failure to file and failure to pay penalties, interest on unpaid taxes compounding from the original due date, and in cases of willful evasion, criminal prosecution. The "I didn't know" defense does not work with the IRS, especially when that crypto question has been sitting on the front page of your 1040 for years.
Crypto is one of the most exciting financial revolutions of our lifetime, but the tax implications are real, they are complex, and the IRS is paying attention in ways they never have before. The good news is that with the right knowledge and the right tools, crypto taxes are completely manageable. Hold longer than a year when you can. Track every transaction from day one. Use losses to offset gains strategically. Use crypto tax software, not a spreadsheet. Talk to a CPA who actually understands crypto, because the difference between someone who builds real wealth with crypto and someone who gets a devastating tax bill they didn't plan for isn't luck. It's knowing the rules before you make the moves. Now you know them.